Welcome to Dorchester Advisors. Today we're going to talk about the financial markets in quarter 3 of 2023. We think you'll find it quite useful. In case we haven't met before, my name is Dushyant and I'm the founder and managing director of Dorchester Advisors. Here we help individuals and families to build solid retirement portfolios that are capable of providing them with enough money to sustain their lifestyle in retirement. So what happened in quarter 3 of this year? Well, the financial markets generally fell in the third quarter, but stayed ahead year to date. Now, we look at 5 broad investment classes: cash, bonds, stocks, real estate, and commodities, which is pretty much the entire investable universe available to professional investors. 2 of the 5 asset classes we follow were up during the quarter: commodities and cash. The other 3, equities, real estate, and bonds, were down. And this generally supports our philosophy that a well-diversified portfolio is an effective investment approach for investors. The headlines in Q3 were a potential recession, high yields on bonds, high inflation, and geopolitical events like wars, dysfunction of governments. And we wrestle with such events from the perspective of what is their long-term impact on our clients' portfolios. So what about recessions? Well, the forecasted recession for 2023, I don't think it will materialize. Now, what about 2024? I don't know, but what I do know is the actions that we plan to take should a serious recession materialize next year. Currently, all things considered, I feel that investors looking for a secure retirement will be able to weather a potential recession the way it's thought of these days. Now, what about high rates? Well, investors, particularly bond investors, are embracing high yields. Clearly, higher yield means more income, but not necessarily a higher total return. And that is the driver of portfolio growth. Yet at the same time, and likely for many of the same investors who value bonds, if they want to borrow money, then higher interest rates means money costs more. It costs more for mortgages, it costs more for business loans, and any other needs that clients have when it comes to borrowing money. Now, in my view, the current interest rates are high compared to recent past, but relative to history, they're quite normal, and the investors and the borrowers will kind of settle down into some kind of equilibrium. And the financial markets have shown that on balance, the relative attractiveness of stocks, real estate, bonds tends to persist even though there are periods of turbulence. And hence, we plan to favor a strong equity bias in our portfolios. What about inflation? When it comes to inflation, we think this is a serious threat to long-term investors. Let's say you need $100,000 to live on today. At the end of a 30-year retirement, you'll probably need $180,000, and that is at a 2% inflation rate. And given that the government and the Federal Reserve are targeting 2%, we think that is pretty much baked into the cake. If inflation runs 3% or more, well, you'll need even more money. And investors aren't prepared for that. And I think this needs serious planning and action right now and consistently in the coming years. As an advisor, I favor a bias towards equities because I believe that is a very good way to achieve growing retirement income and cash flow, and yet preserving enough of your portfolio to prevent a premature decline. Finally, as far as geopolitics go, wars, dysfunctional governments, those kind of things, I view these as societal and political issues. They're rooted in politics, not in financial markets. Traditionally, they do impact day-to-day life, but tend to have only a modest, if negligible, impact on the long-term returns of portfolios. Financial research and my own experience has shown that it's wise to ignore or low-weight geopolitical events. Rather, it's better to focus on a good investment plan. So our plan is to invest in asset classes that have established long-term returns, things like equities. Of course, we regularly monitor our investments to make sure they are delivering on their investment philosophies. We cross-reference investments to make sure that they are compelling, and I keep abreast of new and emerging strategies to add to our investment portfolios if they make sense. Look, there are no guarantees in life, particularly in investment life. But I do believe our investment approach is very defensible for the long term and for long horizon clients. Certainly, I am comfortable investing our money in this manner. So we believe that leaning on time-tested principles is far more important than trying to forecast current events, which I think is a futile endeavor, in my opinion. So I focus on investment principles that have been profitable for us. Things like being an evidence-based investor, keeping diversified portfolios, that's very important, and not confusing volatility with risk, because they're not the same thing. So for our clients, for the rest of 23, we plan to keep well diversified across the 5 main asset classes, be very prudent with any risks we take, and to remain cost conscious. I think this remains a sound investment approach. Thanks for listening in. I invite you to look through our website, and if our philosophy and approach resonate with you, give us a call with no obligations. I love talking all things investing. Thank you.